All right, so we finished the financial statements. Now we're getting into the closing process. And in this video, we're just going to talk about the process. We're not actually going to do it right now. The next video will show you the process in which we close. But I just want to kind of go over the steps, the process of. So what is the closing process? Well, first, it's a step in the accounting cycle that occurs at the end of the accounting periods after the financial statements are completed. So this always happens after the financial statements are done. Okay? And what it's doing is it's getting everything ready for the next year. And in order to understand this, you need to know the difference between permanent and temporary accounts. Permanent accounts are the accounts that report on activities related to one or more future accounting periods. So think about cash. Cash is like your bank account, the cash in your bank account. The cash that you use in your bank account, you're going to use for that year. And then on December 31st, it doesn't involuntarily go down to zero. You may make it go down to zero, but it doesn't by itself go down to zero because that ending cash balance in your bank account carries over to the next year. It is a permanent account. Another example of this would be like a payables account, something that you owe. If you have student loans, at the end of the year, they're not going to call you and say, hey, you know what? You don't have to pay them. No, they want their money, and that balance that you still owe is going to carry over to the next year. That is a permanent account. It's also called an income statement account. A balance sheet account. These include assets, liabilities, and equities. All these things carry over from one year to the next. Now, adversely, these are not closed each period, which we just talked about. They carry over their ending balances to the future periods. Now, adversely, you have what's called temporary accounts. Temporary accounts are the accounts related to one accounting period. So if you think about those movies where people are selling a car and they have this big glass pane and they write the car down and they say, okay, this is what car I sold, this is what I sold it for. They do that for the purpose of their being paid, what they get in commission. Okay. And at the end of the period, when they get their commission, their bonus, they erase that board. They don't keep it up there and they don't keep adding to it, because if they do, then that means that they're going to keep getting paid twice or three times as much as they were getting, because they're getting it counted more than once. They erase it and start over new. That's exactly what temporary accounts do. We erase certain things because we don't want to claim them for more than one period. They only affect one single period. These are our income statement accounts. These include revenues, expenses, and dividends. Okay, I remember these as what we call the red accounts. The temporary accounts are what I call red accounts: revenues, expenses, and dividends. And I do it in that order. That way I don't ever have to worry about missing one. Now, when it is time to close, they are opened at the beginning of the period and used to record transactions and events for that period, and then they're closed at the end of the period. Now, where are they closed to? Well, that comes in the next video. So we will talk about in the next video how we do these closings. Appreciate it.